We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners at Burke Britton Financial Partners. This is episode number 103 of the Finances podcast.
Jeez.
We were just talking before we jumped on about insurance. We had quite a significant session yesterday talking about insurance, which is obviously not huge. For a lot of people, it's not a hugely exciting...
For many people.
Yeah.
Majority.
Well, you said something which I thought was important. Maybe start with that. The process for getting insurance and thinking about insurance can be painful, but there's not many people that complain or aren't happy when a claim is successful.
Yeah.
And again, it happens at times when people have lost a loved one, or there's quite a significant traumatic event or disability, but the importance of it can't be undersold, or can't be oversold, I should say. So what I want to talk about is just some of the basics of, I suppose, what is insurance, because that is a sort of a catch-all phrase for lots and lots of things. But let's talk specifically about sort of personal insurances. So what are the most common personal insurances that we see people needing?
Yeah. So often when I ask a new client, what insurance do you have, they'll send me the home, car, contents, and that's probably a pretty good representation of what people think about when we ask them about insurance.
Yep.
So the main ones that we have are life, TPD, which is total and permanent disability, income protection, and then a fourth, a little bit less common, trauma, which is a bit newer than all the others, still old now. When was trauma brought in? 90s?
It was well and truly in when I was in, so
there you
you're
go.
showing your age now, mate. It was also called crisis cover. There's many different names for them, but they all have, I suppose, a specific need. Maybe let's talk to the importance of each of them individually. So we'll be brief on this, but let's talk life insurance first of all. It should be fairly self-explanatory, but sometimes it's called death cover, life cover, term life insurance. What does it do?
So essentially it's a lump sum left upon passing of the owner. So if something was to happen to me, my life insurance is then passed as per my wishes to my spouse to provision for any debts, my income, and any dependents that we either might have for however long that may be. And that might sound difficult to calculate how much cover I need, but kind of walking through a step-by-step process makes it pretty easy and self-explanatory.
So just hold that thought for a minute when we run through, because we'll do how do we work out how much we need. But second one you said is TPD. We like acronyms. Well, it's an acronym. Do you know?
That's an acronym.
I think an acronym has to be something, is a word that is spelled in letters. Is that right or not?
No.
You sure?
I'm pretty sure, yeah.
Okay.
I don't think that's right.
Okay. We'll edit this bit out of the podcast.
You can Google it while you're going. Anyway, TPD, total and permanent disability, you have to get ticked off by 2 specialists to actually say that you will never be able to work again, potentially in just your own occupation or in any working capacity at all. So that's obviously, I can't go to work. How do I facilitate my groceries, mortgage, living expenses? I need a big lump sum to remove some debt and facilitate an income payment from that. Looks like you have the answer from TPD.
Yeah, I haven't been able to let it go. So it has to create, for it to be an acronym, it has to actually create a word.
Oh, there you go.
The other is an abbreviation.
Oh.
There you go.
Yeah. Would have used that wrong forever and a day.
I think we've used acronym wrong, for 25 years. Sorry, carry on. Disability cover.
That was disability cover.
Yep.
Income protection cover. So if I'm unable to work, but I will be able to go back to work in future, I do have to meet a waiting period, and so that's agreed between me and the insurer. Once I actually meet that waiting period, I can then apply to have, generally it's a monthly sum that's going to drop into my bank account until the point when I'm able to return back to work.
And so effectively replaces your income like a salary until you're able to return to work.
Pretty much.
Yep.
And you can insure up to about 70%, but you can also tailor it back if you know you're not really going to need the full chunk of your income coming in every single month.
Yep. And the fourth one?
Crisis recovery or trauma. So that's in the event of a heart attack, stroke, cancer diagnosis. It's a lump sum payment. Generally, it's probably a couple of years worth of income or some medical expenses that you can foresee, just so you can extinguish those. You might have some time off work, so you need to replace a little bit of income as well.
Yep. And I think one of the things that it's quite clear with people having greater cost of living, the debt that most people hold, the need for insurances it hasn't lessened. It's actually increased significantly, particularly when you think about those people with dependent beneficiaries, so children that they need to support and very reliant on the income, or it'd make difficult to actually support if you still had a big chunky lump sum of debt left to your spouse in the event that you passed. So that probably leads into the next question, which is how do you work out how much you actually need? And I know we spoke yesterday about this idea of retaining or transferring the risk. So maybe if you can just talk to what that actually means conceptually.
Yeah. So in that day we had yesterday, talking all things insurance, it was just chatting about everyone has risks associated with them. If something was to happen to me and I couldn't work, the risks are I need food on the table, I need to pay down my debt. I can actually transfer that risk to someone else in form of insurance. So it does cost me each month to actually pay for it. But in the event that something occurs, I can put my hand up to the insurer and say, hey, I have a claimable event. I need my lump sum or I need my monthly income. And essentially they bear that risk for me. So running through what do I actually want to cover? Do I want to cover my income of however much it might be?
So let's do a practical example. So it's me and I've got 5 kids. I've got $500,000 worth of debt and I earn $100,000 a year. Broadly, how do I work out how much cover I'm actually going to need? I know this is not advice, so don't take this as an exact scenario, but hypothetically, how would you work that out?
Yeah, so you work out, one, do you want to extinguish all of your debt?
Yes, please. Kari wants the debt gone.
Yeah, done. So you know that you're going to transfer that risk across to the insurer. Yep, tick, there's $500,000.
There's $500,000, yep.
How long are your 5 kids each going to be dependent upon you?
Well, Milo's 5, so...
I was going to say you didn't have 5 all at once, they're staggered across. So you just calculate, well, maybe it might be $10,000 a year for each of them until they're 25, stagger them out till that point, or I can transfer that risk across, and then your income. In the event that you're not here, how many years of income would Kari need to
She wants
help?
20 years worth of $80,000 a year.
Yeah, done. Does she want so it would be, when you look at it, how much risk you have your risk until retirement of $100,000 a year. She's actually opted to keep some of that and transfer that $80,000 until retirement to the insurer. So she's keeping $20,000 a year of risk on her book, but that's, I'm assuming you're doing investing in super contributions, so you're probably not spending $100,000 comes in, it doesn't just dissipate in expenses.
Well, what's interesting in that calculation, I can already see your head, you go, okay, it kind of depends. There's multiple factors, but the concept itself of saying, okay, well, I want to clear $500,000 worth of debt. Okay, if we work out that I need a further $1.6 million roughly to replace the income that I would have over a period of time, we're up to $2.1 million.
Well, another discussion is how many assets do you have at the minute? Do you have an investment property? Would you want to sell it? Would you want to keep it? Do you have a bundle of shares that you're happy to just sell down and extend?
Kari wants to keep the investment properties, the super. She wants to keep everything, but she also wants to keep the kids going through private school. So your calculation so we're up to $2.1 million of debt replacement or extinguishment, income replacement, and there's probably another $500,000 of education costs for kids. So we're up to $2.6 million. That's how much I need to insure in my life. How do we work out of that? That's how much I need. How much do I actually retain of that myself, which is your question of, okay, do you have other assets that you would like to sell? Investment properties, super? The answer is no. So am I happy to transfer that risk, $2.6 million of risk, over to an insurer?
And some of that discussion does come down to cost, obviously. We want to start with, I want to transfer all of my risk out, pending how much it costs me. Insurances can be quite expensive. The younger you are, typically, the cheaper it's going to be because you're less risky than someone who's 60 years old, probably has a few more health ailments.
That's probably sometimes not always that evident to people, but the way insurance works is you are assessed based upon your age, your sex, your occupation.
And genetics.
Genetics, so family history, mother, father, sister, brother, hereditary diseases, and also your own personal medical history. So it's a fair bit that goes into making sure that we can work out what your premium would be. And to your point, the earlier you can be insured, the better, generally speaking, because you're going to be in better health, you're going to be younger. In most cases, you're going to be better off to get it earlier.
Yeah, you don't want to have to go back every other year to go and get more cover as well. Going to get cover can be a little bit finicky, can be a drawn-out process. So actually doing this early, first home buyer is a great opportunity to actually go, got some debt, I have risk now. I can go and put my hand up and transfer that across to the insurer. Generally, being younger, you're probably going to have a better chance at actually getting that insurance cover that you need and want, and for a cheaper premium too. Then maybe down the years, I'm going to take on more debt. I only have to go back, but that cover that I've got potentially doesn't have exclusions, doesn't have loadings on it, so I don't have any health ailments that need issues or anything like that yet, but a few more years of footy I might by the time I buy my next home. I can keep my kind of golden cover with no exclusions and loadings. The next piece of cover I might have a loading for bad back or something like that, but the cover that I've got I'm going to retain for as long as I can, because that makes sense that it's pretty well golden for me.
I think that idea of getting it early but then reviewing it regularly, how often should people be reviewing the insurances that they actually do have?
Probably doesn't hurt to review it every 2 to 3 years really, but as soon as something actually updates in your either lifestyle or financial life.
So what would they be? What's an example of something that...
Kids, marriage, death in the family, and inheritance from mum, dad, grandma, something to that effect. Anything that really sees your financial or even increase in expenses. I want to do more travel or really anything of a financial nature. You just go, probably time to just take a step back, get my ducks in a line, have a look, and it might be fine. Insurance is a little bit funny because it's never, ever perfect. Whatever calculation we do today will be different tomorrow, because I'm going to go and buy my groceries, so my bank account's going to drop a bit, share market's going to have come up a little bit. It will never be the same today as it was tomorrow. So making sure that you're comfortable with the level that you've got. And again, you assess, do I need to transfer more risk to someone else, or am I comfortable with that $100 worth of risk or $100,000 worth of risk? That's ultimately, it's up to the individual really, but you just go and look at how much risk you have, how much I want to transfer, and I have to be comfortable with the rest.
Yeah, I love that idea of retaining or transferring the risk, because it's something that can be fluid. Like you said, as you acquire more of your own assets, they're the assets that maybe you'd be happy to form part or realise or cover some of that risk. So you've bought an investment property, it's grown in value, your superannuation has grown, your non-super investments have grown, and you're then back reviewing your insurance. You can say, well, actually, I've got assets now that I'd be happy to liquidate in the event that I passed, and will help support my family to provide all of those income, debt replacement and dependency needs. And on the flip side, there might be a situation where, as you said, you take on more debt or income needs increase, in which case you've got to actually transfer more of that risk. You've got to get a little bit more insurance to cover for the additional mortgage that you took out, or the fact that your income's gone from 100 to 150 grand and your household actually needs that. So you've grown accustomed to that being your cost of living. Again, I think even though insurance is, it can be a pretty dry topic.
It's going to be the best investment that you never want to use.
Yeah.
Like it is the best value for money, just tipping money away monthly or annually, knowing that if something happens to me and my family, we're sweet. Not that I can just, all right, I don't have funds flying out everywhere. I can still continue to invest. I can still continue to make super contributions. I don't necessarily plan to just sit still. If something's going on, I still want to grow my wealth through and travel and do those sorts of things. I don't want to have to just sit still if something's going wrong financially.
I think that we're striking that balance between how much risk you're happy to accept yourself and transfer is super important, because you could insure for the perfect level of cover, but it might cost you so much that you cannot then afford to invest any money for your kids, put anything additional into super, pay any more off your mortgage. So having that balance, striking that balance and finding that happy medium of the amount of risk that you're happy to take that's actually cost effective in that it fits in with your cash flow, or if you're holding that insurance within super, that is not eroding the balance of your super negatively. I think that's where getting some support and actually having the conversation. I just did a podcast with Peter where we talked about sometimes it's hard to quantify the value. You think about the value of getting insurance advice. You go, I'm getting advice so that I can pay a premium for something that I hope I never claim upon
at all.
Yeah. A lot of the times the value is actually having those discussions so you can actually rationalize the risks and think about what would I do in the event of. And it's interesting that whenever we start to talk about insurances that are pretty dry and can be pretty morbid and can be difficult for some people to talk about, it actually opens up a lot of other discussions about how you make the most effective use of the income and the assets that you do have, because inevitably the conversation that you have around your insurance flows on to discussions around superannuation and retirement,
future debts, future expenses. I want to spend 60, 70, 80 grand in retirement.
Yeah, family planning and what's going to be need to put in place to protect a growing family, how much debt you can afford to take on, how you manage your cash flow. Everything is interrelated. When you start to talk about insurance, obviously then you dive into the estate planning part of people's world, which again is another one that's commonly overlooked, but not many people that we see unhappy that they've got an up-to-date wills and powers of attorney in the event they either have a family member pass or they have a disability or the need to actually act on someone's behalf. So it's not a problem until it's a problem. So yeah, the best time to sort this stuff out is as early as you possibly can.
Yeah, always try and sort it out before you need to sort it out.
One more. So what are the idea of exclusions and limitations on death, disability, income protection, trauma? What is an exclusion? So is it just as easy as going and applying for cover and they give it to you? I want $2 million worth of cover. I fill out a form, send it off, and I get it?
Some insurers are actually different in that they will have a full medical form that you have to work through. What we actually like to see clients do is go through the medical underwriting process. So each insurer, be it MLC, TAL, AIA, whomever, they have a team of underwriters, and what they do essentially is call you up and run through your medical history, what you do for work. Is there anything dangerous that you do? Are you working above 5-6 meters every day? As well as, we touched on it before, genetic disorders that might be, mum, dad, brother, sister, see what's going on there. And then a lot of it, some clients, some people can feel that they might be getting picked on or looked down on when they do have something wrong with them. But from the insurer's point of view, it is purely statistical, because if my mum had cancer at the age of 45, the likelihood that I will have cancer by that age is high. So why would I then be entitled to really clean cover that someone else who doesn't have that likelihood would be? The insurer's going to be out of pocket a lot of the time, so you actually just get popped into a pool of other people that are in a similarly risky place in their life, and that makes it really affordable for the insurer. Otherwise, if we were all just lumped in together and everyone got golden cover, no one would be able to afford it. The insurers would either be out of business or no one would be insured anyway.
So the young people with a clean bill of health would be sort of essentially covering the premium for those people with the high risk events, and that's probably not that fair, is it?
No.
So they tend to load or exclude your individual cover based upon the risks, the statistical risks that you are going to actually make a claim. And it makes sense, and it is an important point. They're not picking on you personally. They're just looking at statistically whether or not you're likely to claim.
And that's a big part of our process when we actually go and apply for cover. So we do a pre-assessment. We ask a number of the questions that the underwriter will, and we actually flag it for all these underwriters anonymously. We just say, John Doe might be 48. He works here. He's had these underlying health ailments. This is his family history. Would you insure him? And then we look at, based on those responses, who we're probably best to target in terms of applying for cover with a particular insurer. All insurers, all their underwriters see it a little bit differently. So just making sure that you know who you're applying with and why. Doesn't always come down to exactly, these guys are $5 a month cheaper, let's go with them.
Last question. What's the process of making a claim? So if someone's got insurance and they want to make a claim, either partner's deceased, there's a disability, they're unsure whether or not it fits within the criteria of making the claim. What do we encourage people to do, and how do people go about making a claim?
Well, advised clients, so clients of ours, we just want them to touch base with us immediately. I think I'm able to claim on my income protection. I've got an injury. All right, cool. We'll wait out the wait period and then we'll begin that process. The process will generally be, you've got to have medical certificates, TPD. You need to be ticked off by 2 specialists that you can never work again. But you want to really flag it in the eyes of the insurer. You want to kind of jump up and down and make sure you're in their face going, I'm trying to make a claim. Tell me exactly what I need. It's probably going to be similar to the application. It won't be an enjoyable process. It'll be quite administrative. But on the other side of that, you know that I'm going to get assessed with a successful claim, generally. It'll be well worth my time. So that might be you're doing doctor's visits. I need to get blood tests. I need proof from work that I haven't been there for 6 weeks, something like that. So sending bank accounts off to your insurer, because they have to do their due diligence. They're not going to pay out $1 million to someone willy-nilly. They're going to do a pretty good background check on you.
A good point about advised clients. most of those clients that we see 6 monthly, 12 monthly, we're aware of what's going on in their world. So if they've got an illness, an injury, or they've had time off work due to illness or injury, that we know about it and we're starting to put the wheels in motion of planning on the claim. Part of the value, I suppose, of having an advisor is that claim process is cumbersome. Having someone that can actually take that off your hands is super important. The other thing which we deal with a lot is under sort of terminal illness. Life insurance also pays out in the event of terminal illness. In most instances, if someone's got less than 2 years to live, there's potential to actually claim, but also plan on what you'll actually do with those proceeds well and truly in advance. So I think anyone, if you're listening to this and you're not sure about what insurance you do have, a good place to look is probably in your super. So you've got some death, disability, income protection potentially that might be in a super or multiple supers that you've got. And starting to ask yourself those questions about, okay, what would I want to happen in the event that I was either deceased or disabled or I lost my income? Would I want to pay out the debt? How much debt do I have? How much income do I have? Or how long would I want to replace that for my family members? They're really good starting points. And then if you're still unsure what you should be doing, you need to make a time to speak to Shay, because he's going to help you out. He's going to work out how much of that risk you want to retain, how much of that risk you want to transfer to an insurer. And then importantly, most people are going to say, okay, well, that's cool, Shay, but what does it cost? Just in terms of the cost, maybe in terms of the parameters to adjust the cost, because obviously cost is a significant thing for most people today with cost of living pressures. What are the kind of levers you can tweak with insurances broadly to make it cheaper, more expensive?
So obviously, as an individual, if I go and apply for cover, the less beneficial it is for me, the cheaper it's going to be. So the less cover that I apply for, the cheaper. With income protection, the longer I wait till I can claim, the cheaper it's going to be. And again, if I'm only trying to get cover for 2 years on income protection rather than till I'm 65, that's going to be a lot cheaper as well. A lot of life TPD, they also have a number of benefits and features that you can turn on and off. So double TPD, buyback features, not required for anyone, everyone. So having a bit of an understanding of those and when I should turn them off, why I should turn them off. Insurance is a really complex field, and it's probably our job to make it as simple as it possibly can be. So the client comes in, they say, I'm retaining X amount of risk. I've transferred this amount to my insurer and it's going to cost me $50 a month, $200 a month out of pocket, and $1,000, $5,000 a year out of super. Cool. I have complete clarity on what I'm covered for, when I can claim for what.
I'll see you at review or when something changes. Yeah. Well, good conversation, Shay. I love that idea of retaining or transferring risk. I think we'll use that sort of terminology and verbiage a lot more with clients. But if you're out there thinking how much you need, have a think about that. How much risk do I want to retain? How much am I happy to transfer to an insurer? And then come and speak to someone to work that out. So, Shay, thanks again, mate. We'll see you next time.
Thanks for having me.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at Burke Britton FP, or Google Burke Britton Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to don't be a moron and act on what some random person says on a podcast. Take personal responsibility, do your homework, ask questions, and speak to an actual human that knows what they're talking about before you do anything. PB Financial Solutions Proprietary Limited, trading as Burke Britton Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.